So you've opened a first home savings account, an FHSA. That's an amazing first step. But are you really squeezing every last drop of value out of it? Today, we're going to break down exactly how to turn your FHSA contributions into a serious tool for shrinking your tax bill. Let's get into it. Let's be real. The whole point of this account isn't just saving for a home, is it? It's also about getting a pretty significant tax break, like right now. This is a huge advantage, and we're going to make sure you know exactly how to cash in on it. Yeah, the rules from the Canada Revenue Agency can sometimes feel like, well, like they're written in another language. But don't worry about that. In the next few minutes, we're going to cut through all that jargon and give you a clear, simple playbook to follow. So let's start with the basics. What exactly is this deduction? Honestly, you should think of it like a financial superpower. Pretty much every dollar you contribute, right up to your limit, can be used to directly lower the income that you pay tax on. It's truly one of the best tax-saving tools out there for anyone hoping to buy a home. All right, let's dive into the playbook. These are the foundational golden rules that you absolutely have to know. Getting these right is the key to making this whole thing work smoothly. Okay, you're going to want to listen up because this is probably the single biggest point of confusion out there. Unlike an RRSP, the FHSA is super strict. Contributions run from January 1st to December 31st. That famous first 60 days rule that you use for your RRSP, for the FHSA, just throw it out the window. It does not apply. Period. And here's a piece of paperwork you just can't skip. The second you open an HFSA, you have to file Schedule 15 with your tax return for that year. And I don't care if you put $0 in it. You have to file this form to let the CRA know that your account now exists. All right, enough with the rules. Let's make this real with an example. Meet Chandler. He opens his account in April 2025 and puts in $5,000, all within that same year. So the question is, how much can he deduct when tax time rolls around? And the answer is, well, it's beautifully simple. Because he put that $5,000 in between January 1st and December 31st of 2025, he can deduct the entire amount on his 2025 tax return. It really is that straightforward. Okay, you've got the basic rules down. So, how much can you actually deduct? Let's look at how your maximum is calculated. It might look a little intense on the government website, but trust me, the idea is really simple. First things first, let's talk about the lifetime cap. The big number to keep in your head is $40,000. That's the absolute most you can contribute and deduct over the entire life of your FHSA. But okay, what about this year? For the tax return you're working on right now, how do you figure out that number? Well, the good news is it's way easier than you think. It's a simple two-step process. So here's how the CRA thinks about it. They start with your total FHSA participation room. Just think of that as all the contribution space you've built up over time. Then, they just subtract any deductions you've already claimed in past years. What's left is your max deduction for this year. Simple, right? But honestly, here is the best part. You don't actually have to do any of this math. The CRA tracks all of it for you and just gives you the final number on a document called your FHSA participation room statement. Okay, so where do you find this magic statement? You've got a few options. You can check your latest notice of assessment, look for a specific form called a T1028, or probably the easiest way, just log into your online CRA account. You'll find it under the Savings and Pension Plan section. All right, let's get into the fun stuff, strategy. What if you contribute money this year, but you know you're getting a big raise next year? Well, you can play it smart and save that deduction for when it'll save you even more money. This is called carrying it forward. Let's look at an example. This is Najia. In 2025, she contributes her full annual limit of $8,000 into her FHSA. So now she's got that money in the account growing tax-free. But here's the clever part. When she did her 2025 taxes, she strategically chose not to claim any of that $8,000 as a deduction. She decided to save it or carry it forward to use in a future year. Okay. Now let's fast forward to 2026. Nadia contributes another $5,000, and this is where her plan really comes together, because now she has two different pools of deductions she can use. And just look at this. This shows you exactly how powerful that move was. For her 2026 tax return, Nadia can combine the $8,000 she carried forward from 2025 with the new $5,000 she just contributed. And bam, she now has a massive $13,000 deduction she can claim, all at once. Okay, let's switch gears to something really important, the traps.
These are the common pitfalls, the mistakes you absolutely want to avoid so you don't get into any trouble.
All right, trap number 1. This is a biggie. You can move money from your RRSP to your FSHA, which is a great feature. But, and this is a huge but, you cannot deduct that transferred money. Why? Because you already got a tax deduction when you put it into your RSP. The CRA doesn't let you double dip.
And we are circling back to this one because it's so important and it catches so many people. A contribution you make in January or February of 2026 can only be used for your 2026 tax return or a future year. You can't apply it backwards to 2025.
Just look at what happened to Arlene. She put $5,000 into her account in January 2026 and thought she could use it on her 2025 return. Just like she always does with her RRSP. What happened? The CRA said nope, not allowed. That $5,000 deduction is still perfectly valid, but only for her 2026 tax return, not the one she was trying to file. So, there you have it, the rules, the strategies, and the traps to avoid. The power is really in your hands now. You can claim your deduction immediately to get that instant tax relief, or you can play the long game and carry it forward for a bigger impact down the road. So the real question is, what's your strategy going to be?